Now coming to domestic trends, so one of the major macro events of this month was the RBI policy. So before the RBI policy, like we mentioned in the beginning, the rupee since the in fact in the last 12 months has been underperforming the rest of Asia. We are seeing significant FPI outflows on the net FDI. Also, we are seeing meaningful repatriation, which is leading to marginally negative net FDI, and that's why we are seeing rupee underperforming. And of course, as crude prices went up, there was a concern that our current account deficit, which was close to 1 to 1.2%, may spike to 2 to 2.5%. And in that backdrop, if we don't get capital flows because of the earnings pressure, probably rupee may come under further pressure, and we saw meaningful depreciation of INR as well. And hence, there was an expectation before the policy among some market participants that RBI may, you know, carry with a slightly hawkish forward guidance to protect INR. Also, given the spike in crude oil prices, RBI may be slightly cautious, and their commentary again could be hawkish. But if we look at the actual policy, what they have done is they have been quite steady as they have been in the last 12 months. So they unanimously voted to keep the policy rate unchanged at 5 quarter, and they decided to maintain the neutral stance. The key assumption behind RBI's action is that it's a supply shock. So just like what we saw during COVID, that it's a even if let's say the economic activity were to pick up, the problem is not low interest rates. The problem is the lack of supply of key raw materials, which is leading to this high inflation. So just like in COVID, the central banks could not control materially inflation, whether they were to hike or to remain accommodative. We are probably facing a similar situation. So when you are seeing a supply shock, it's better to wait and watch. It's better to see whether how long that supply shock lasts. Secondly, whether that supply shock is leading to demand destruction or it's leading to second round price effects. So just to give some perspective, any kind of oil price shock would also lead to some demand destruction because in a way it is a tax on the consumers, so their disposable income is going down. It will lead to lower aggregate demand in the economy. So a central bank always has to see at what oil price it leads to more inflation, than probably a major economic slowdown. So that's what RBI is doing. It's waiting and watching to really see where oil price settles, where currency settles, and then assessing, how to uh, unfold their monetary policy. The other thing which market was also awaiting from this policy was RBI's new CPI forecast and growth forecast, which would give markets some color on their possible rate action going ahead. So, if you would remember, in the last policy in February, RBI had not shared their full year forecast for inflation or growth because we were awaiting the new CPI and growth series. So as the new CPI and growth series were released in February, which have updated their various components as per the new economic needs, so RBI has also factored that new series in. And as per their assessment, inflation is likely to average at 4.6% during FY27. The RBI also releases semi and monetary policy reports semi-annually, in which they take their key assumptions behind their inflation projections. So if you see, they're assuming an $85 barrel from $70 barrel in October 25, and for the currency also they've assumed a weaker USD INR at 94 from 88. Now, of course, the risks are both towards upside and downside. If El Nino conditions were to fructify in May and June, probably we will see further pressure on food inflation. If the conflict continues to intensify going ahead, or the ceasefire does not hold up, we'll probably see even higher crude oil prices. At some point of time, government will have to pass on those fuel prices to consumers. So far, they have reduced the excise duty and they have taken a hit on the fiscal side. But if this oil price continues where they are, at some point of time they will have to also increase the retail prices, which could lead to much higher inflation. So so broadly, the 4.6% number that RBI has projected right now, it assumes oil at 85. If probably oil were to settle between 95 to 100, then probably that inflation will get close to 5%. And growth right now has been projected at 6.9%. So if you, as you can see, the RBI assesses that there could be some impact on the first quarter and second quarter GDP because of this conflict, but they do expect the conflict to resolve by the second half of the fiscal year. And as you can see, in the Q3 of FY27 and Q4 of FY27, they're expecting growth of about 7%. The other thing which market was also waiting for RBI to give its signal was on liquidity. So as some of you might be aware, liquidity has been surplus um, all throughout Jan to March because of record RBI OMO and FX buy sell swap. And throughout the year, just to put things in perspective, RBI has an OMO of more than 7 lakh crores, and in fact, since December onwards, it did an OMO of 4 lakh crores. So as a result of which, huge liquidity got created in the system, and the overnight rate has been trading below the policy rate. So typically, in a neutral stance, RBI has preferred that the overnight rate stays at or slightly over the policy rate. But for the last 3 months, overnight rates have been lower than the policy rate. So as now the new season was starting, there was a pressure on inflation because high oil prices. There was a pressure on the currency. So there was an expectation that probably RBI may not hike rates, but it may start to tighten liquidity. But if you look at the commentary yesterday that RBI made on liquidity, they want to focus on monetary policy transmission. They they reiterated that they will keep liquidity surplus, and they even in fact reiterated that they will be preemptive in liquidity. So there were some apprehensions in market participants that RBI may start doing a more aggressive variable rate reverse repo auctions where RBI absorbs liquidity from the market and thus tightening overnight and money market rates. But RBI was quite clear yesterday that they will continue to provide liquidity, and hence we don't expect aggressive variable rate reverse repo auctions, any absorption of liquidity by the RBI. In fact, typically RBI announces their dividend in the month of May, June, and the government has estimated more than 2.3 lakh crores of dividend. We think it could even be higher. So probably RBI will end up paying 2.5 lakh crores of dividend to the government, which would again infuse liquidity in the system. So as money moves from the RBI balance sheet to the government balance sheet and government starts to spend, all that liquidity comes back in the banking system. So we do expect on top of the current 3 lakh crores liquidity, further 2.5 lakh crores liquidity to come from RBI dividend. So overall, we expect a very positive and surplus liquidity situation in the foreseeable future. So broadly, RBI, was quite clear that they are not using interest rates to target currency. They are comfortable with currency depreciation as long as the depreciation happens orderly. They will continue to remain on wait and watch and really assess the duration and intensity of the conflict and its impact on oil prices and other second round impact on inflation. So they continue to be on wait and watch. Broadly, what it means to the market, we believe that at least for the next couple of policies, unless and until we see a huge oil price shock, we do expect RBI to stay in wait and watch mode. Probably at least in the next couple of policies, we don't expect any action on the RBI on the liquidity part also. And only by end of the year, RBI may probably, as inflation unfolds, they may start to look at liquidity measures or at least changing their forward guidance to take into account the next policy cycle, and hence we expect lower for longer rates. So unless and until the geopolitical situation escalates, which results in structurally higher oil prices, we expect RBI to stay put and expect lower for longer rates.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.